So now we have supply zones, and supply zones are drawn the same way as demand zones, just flipped. It's just the opposite of demand zones, but we're talking about supply, so we want to see everything from the upside, followed by a strong move to the downside, right? So same thing as demand, we're looking to the left of the chart if we're talking about today. We want to find if price is coming into a supply zone, we're going to look at the left to the left of the chart. We then want to identify a basing candle followed by a strong move to the downside, right? So we have a basing candle here, and we have a strong move to the downside. So this qualifies as a supply zone. The zone now, this is different. This is how it's different from a demand zone. The zone starts from the bottom of the body of the basing candle. So the bottom of the body is going to be right here to the top of the wick if we do have any wick, right? So that's our supply zone. We only trade after and if price returns to this zone, right? So once we see price now coming up to the zone, as you guys can see here, we will then look to buy puts or sell short and put our stop loss somewhere in this area above the supply zone, right? Because price now possibly can reject and come to the downside because we have a supply imbalance from the past. So just like everything else, we're looking to the left of the chart from wherever the current price is, right? We want to identify a basing candle followed by a strong move to the downside. So we have a basing candle right here, followed by a nice, solid, strong move to the downside. This qualifies as a supply zone, right? So we draw from the bottom of the body of the basing candle, bottom of the body, to the top of the wick if we have any wick, right? That's going to be our zone, and we only trade after if price returns to this zone, and this is when we'll find our low risk, high reward trading setups. As you guys can see, this is the same chart. Look what happens when price entered this zone. We get our first rejection, some unfilled orders get filled here, right? Then the same day, we get another rejection from the supply zone, and look how strong and violent this move is to the downside, right? This is just from a supply imbalance. This is just from a supply and demand equation becoming so skewed, and the unfilled orders are getting filled by some people that are chasing and buying the stock, right? So here's another supply zone. We get a nice basing candle here, followed by a nice strong move, this nice strong red candle to the downside. So this qualifies as supply. As you guys can see, price rejected the supply. Even though we're in this zone multiple times, I still look for an entry because it's such a tight zone. So I'll still look for an entry here, right? My risk is very minimal for possibly a high reward, right? So I'll still look to enter this zone once I see a rejection. What's important is to notice is you want to look at a rejection from a smaller time frame. So this is a 4-hour chart we're looking at, right? I will qualify this as a 4-hour zone, but for me to enter the trade, I'm looking for a rejection of this zone on maybe a 5-minute or a 15-minute chart, right? I don't just enter a supply or demand zone once the stock reaches the zone. I wait for a rejection. I wait for confirmation, and I wait for a candle rejection, or maybe I wait for some level 2 action or time and sales action, and I see sellers are stepping in or I see buyers are stepping in for a supply or demand zone, right? So I want to maybe see a lot of sell orders here, or maybe I want to see a lot of buy orders if I'm looking for a demand zone. And you could tell that by the time and sales. So I don't just hop in right away. That's important for you guys to understand for both supply and demand. I wait, I look for a smaller time frame confirmation, I enter, and I put my stop loss right above the zone. So same thing as demand zones. This can form from any time frame. You just need a consolidation basing candle followed by a strong and violent move to the downside. We're talking about supply, so we're talking about a downside move. We're selling in supply. Always start with a higher time frame and you move down to the smaller ones. Like I said, you could start with a monthly or weekly, then work your way to dailies, then 4-hour chart, then a 2-hour, 1 hour, 30-minute, 15-minute, 5-minute. You can still find supply and demand on a 5 or 15-minute chart, but I use the 5 and 15-minute charts for confirmation, candlestick rejections in a supply or demand zone, then I enter the trade. Once I get that confirmation from a smaller time frame chart, I enter and put my stop loss right above the zone. So it doesn't matter how long in the past the zone has been sitting there. All that matters is if we have a fresh zone with a lot of unfilled orders, because that's when we'll have the high probability trades. I wait for the stock to reach that zone, and once it reaches that zone, we'll be in an imbalanced period, and I'll sell short. I'll buy puts accordingly, right? You'll get used up zones will be less probability. There'll be lower probability trades because the more orders it will fill, and the greater the chance the zone will break and will not work. So here's another example of a supply zone, and here's Amazon. We get a nice consolidation candle here, followed by a nice violent move to the downside. So I draw the zone from the bottom of the basing candle to the top of the wick, follow along. I wait for price to then reach this zone sometime in the future. And as you guys can see, price reaches this zone. We get a solid rejection and we get a nice move to the downside solely from the supply equation being imbalanced right here, right? Here's another example. Now this is a 15-minute supply zone. So we get a nice drop. Then we get a basing candle right here, followed by another nice drop. So I draw the zone from the bottom of the basing candle, the bottom of the body to the top of the wick. And as you guys can see, price then rejected right here. We get nice 3 candles on a 15-minute chart. Solid rejection because you guys can see the wicks rejecting this zone, right? So this is what I would look for on an intraday basis if I want to take the trade. I'll wait for these wicks to reject. I like to see a lot of upper wicks. Then I'll maybe get an entry, right here somewhere and put my stop loss right above the box. But this is what I mean when you want to use a smaller time frame chart to get and qualify entries based off the supply or demand zones. So here's Amazon on a daily chart. We get a nice basing candle followed by a nice violent move down, draw the zone, I look to the right, and look what happens when price enters this supplies imbalance, right? It's very simple, guys. It doesn't have to be complicated, but you want to make sure you guys are qualifying for the right zones. You guys don't want to just plot zones and take the trades off zones that aren't valid. You want to make sure they're valid. And the only way to validate and confirm these zones is only if we get a basing candle followed by a nice strong move to the downside, right? So here's another candlestick and a chart pattern that I look for, but this is for supply zones. It's the same thing as the rally base rally, but it's for the downside and supply zones. It's called a drop base drop, DBD. We get a drop downwards, right? Then we base out. Then we get another drop downward again. It's a bearish momentum pattern. So what happens is price pushes down and it creates a short balanced period, right? You guys remember the balanced period is when we base out. So we get a balanced period. And during this basing out balanced period, I do not trade here because this is where institutions are leveraging in their positions. And then we get our second drop down. So the only way this qualifies as a supply zone is because we get this second drop down. If price then started to move back up, let's say right here, right? And we didn't get this second drop, this would qualify as a demand zone because now we move up strong and violent to the upside. So the only reason why this qualifies as a supply zone is because we get this second drop to the downside. So basing period is where the institutions collect orders to fuel the next drop. 2 ways you can play this. Same thing as the rally base rally. You can get this. You can sell short, buy puts at the break of this base to the downside, put your stop loss at the above it, or you can wait for price to come up, hit the supply zone, reject it, and come back down and make money and profit for the ride down, right? So here's Tesla. Here's a drop, right? So we get a drop here, we get a base here, and we get another drop at this candle. This qualifies as a supply zone. We wait for price to re-enter the zone. I do not trade until price reaches an imbalanced period. It's important to never trade, or if you follow this system, to never trade in balanced periods where price is in the white space, or price in this case is in the dark space, because you don't want to trade during balanced periods. I only trade where these imbalances occur. That's when I'll get my best entries. So as you guys can see, we have another drop here, we base here, and we drop again here, right? So this is a drop, base, drop. We have 2 drop base drops next to each other. Here's our basing candle followed by another drop. So we draw at the bottom of this body to the top of the wick. We wait for price to come. You guys can see we hit it here, we come down accordingly. We hit it here, we come down accordingly, right? It's very simple, guys. Please do not overcomplicate the process. Another example, right? We have a basing candle followed by a shot down before the close. Then we open up and close down even more, right? I draw this zone. Look what happens when price reaches this zone. It's more towards the end of the day, right? So look, they close it in a supply zone. You have people, you have retail traders buying it, maybe swing trading it, holding it into tomorrow for possibly a gap up. If you know there's a supply zone here, I would never hold this overnight. I'd be looking to sell this thing short overnight or buying puts. We close in a supply. Look what happens the next day. We have bad news or something and we gap down, right? So that's another trick they do is they close stocks sometimes in a supply zone, or they'll close them in a demand zone and they'll gap them up, right? Or gap them down. What they do is they trick these retail traders in buying before the close. They make it look good. We rally into the close. Retail's buying, right? Providing them liquidity for their sell orders. And look what happens. They release news the next day. We have a nice gap down, right? It's just the trick institutions play. So knowing where these zones are will protect you guys, and knowing where these zones are will make you guys profit, right? It's very simple. Please do not overcomplicate this at all.